All right, welcome back. It's Decatur Low with LSI Enterprises. What we're gonna do is make a quick video trying to explain something that a lot of people call complicated. When you hear back in the day Barack Obama, you hear some of these people on CNBC talking about complex derivatives. That's what they talking about, stock options, y'all. And I'm gonna try to make this as simple as possible for you. All right. So what's a stock option? By definition, it's the right to buy or sell a certain amount of shares, in particular 100 shares. Contract basically documents stating the terms of your right to buy or sell. I suggest y'all write these down on Snapchat if you're really trying to get into learning about these options. You need to know these terms. Call option is the right to buy your shares. A put option is the right to sell shares. What does it mean to exercise? Well, to exercise is the act of executing the terms of the contract, basically meaning by a certain date, you got the right to buy a certain amount of shares or a right to sell a certain amount of shares. You got me? All right, so if you don't know anything about real estate, let me break it down to the young folks. When we talking about renting and buying, when you talking about renting and costs, you got an option to lease, basically like renting. And they got something called lease option where you can lease it for a certain period of time. And if you decide that you like the property, you can actually exercise your right to buy the house based on the price that's in the contract or the lease option contract. All right, so when I'm talking about this stuff, these are the analogies I'm going to use. Take a look at that. I'm not going to read it out and insult your intelligence because I know you know how to read. Need to, you can come back to this. All right, so here we go. Boom. So let's assume you got this house. Let's say I'm selling the house. Let's say the house is worth now is worth 100,000, right? And you are renting the house, and you say, "Well, I really love this house, and I'm thinking about buying it, but I don't know if I want to buy it right now." So I say, "Well, you need to make a decision, otherwise I can rent it out to somebody else because I'm thinking about selling it." You say, "All right, here's what we're gonna do. We'll give you a down payment, 5% of the value, which is $5,000, right? And if you give us till May the 1st, we'll make our decision to buy the house, right? If we want to keep the house, we get to put that $5,000 on times our down payment, and then y'all buy the house from me, right? 100,000. So that's the deal. That's the contract, right? Okay. Expiration date comes up. It's May the 1st. My house don't jumped up in value for some reason because, hey, we heard that they finna build Microsoft and Google, all this stuff, whatever. So it went up to $150,000. I already wrote a man a contract. I wrote you a contract saying that I'll sell it to you for 100,000 on May the 1st. Well, it's May the 1st. I can't renege on my contract. So here's a couple of options that you have. You can go ahead and exercise your right to buy this house for $100,000, right? And you'll have $50,000 worth of equity, right? Or you can sell the contract. Let's say you say, I don't want to live in Georgia no more. I want to live in Florida. But this $5,000 that I invested in this contract, that contract itself is worth $50,000 now. Think about it. The house is worth 150,000. You got the option to buy it for 100,000. So even if you don't sell it for 50,000, you pay 5,000 for it. Worst case scenario, you can sell that piece of paper for $25,000, right? You'd have made what? Um, 5 times your money. You got me? That's one scenario, right? Second scenario, that house goes down by May the 1st, right? Something happened, bunch of crime. Now the house is worth 75,000. You put in the contract to buy it from me for 5 grand. Why would you exercise your right to buy this house right now? It don't make sense. You mean tell me you already put down 5,000 and you're gonna pay 75,000 to buy this house, even though it's worth 100,000? I mean, you're gonna pay 100,000 to buy this house, even though it's worth 75,000? That makes no sense. So what you would do is this: you'll take the L and lose the 5,000. It's better than losing the 25,000, right? See how that works? And then you can look at this other information over here later on when you pause it and go back and get the detail, um, a better view of what I'm trying to say right here. But that's the basis of it. Now, what does it have to do with stock options? Check this out. It's the same scenario. Instead of purchasing the house, you sign a contract to buy 100 shares of Apple stocks from me. right? At $100 per share. So at the time of signing the contract, let's say it was $100 a share, right? Or that's the decision you made. So what we're gonna do now is say, okay, the contract said that by May the 1st, no matter what happens, you can buy 100 shares of Apple from me at $100 per share. Let's look at two scenarios. Well, it's May the 1st now, right? Those Apple contracts went up to $150 per share, right? That's a 50% increase. Now, what are your options? You can exercise that, right? You paid $100 fee. It's just like the down payment. You paid $100 in order to get that contract, right? Now you can buy 100 shares of Apple from me for $150 a piece, right? That's $15,000. Basically, you can spend $10,000 to buy $15,000 worth of shares. You have that equity, just like last time. So you have like 5 grand in equity. But that contract, you don't have to buy the shares. Let's say, you know what? I don't need no Apple shares. I'm gonna take my profit and go. So what you can do is sell that contract in the market, and it's gonna go for that. One thing about the stock market, it's gonna go for market value. You got me? So you can turn that $100 into $5,000 just like that. If that stock went up 50%, $50, your contract worth $5,000 now. Now I'm gonna give you some basic math and get too deep into it, but basically, if I charge $1 per contract, that's how I get to the $100 fee, right? So if it's $1 per contract, now these particular contracts that went up to $50, right? So you do 50 times 100, that's how I got to 5,000. If that sounds complicated, don't worry about it. Pay the 100, now it's worth 5,000. You got me? That's the first scenario, if it goes up. Second scenario, you know how the stock market is volatile, meaning it goes up and down. Let's say your shares go down to $75, right? Something happened, Apple had bad news, they had bad earnings. $75 a contract, I mean per share. Do you exercise the right to buy 100 shares of Apple from me for $100? No, it makes no sense, right? Why would I pay 75? Why would I pay $100 for something that worth $75? So the good part about that, if you read all this information right here, I lost $100, but at least I avoided losing $2,500, right? You got me? The owner, me, and this is what I do. This is the scenario for cover calls. This is how I built up 30% of my portfolio. I get to keep the $100 you gave me. That's the little premium, right? I made that in a couple of days, right? Because that contract expired worthless. Put the $100 in my pocket. Now I still keep my $100 shares, right? And I can resell another contract against those same shares. Keep it moving. I just collected premium from you. And this stuff sound out there right now, but the more you get into this and double back to this video, you're gonna be like, that man was talking about premium. He was talking about expiration date. It'll make sense to you. So these are the two scenarios. This is stock options. Try to make it simple for y'all. If you think about it, go back and look at the video. You simplify it in 1 minute, it's just like buying a house. Lease options, you got option to buy it, right? Or you can buy and sell that option. It's on you. Same thing with the stock options. You got a right to buy those 100 shares, or you got a right to exercise and buy them, then sell them, or you got a right to take that piece of paper in the middle, piece of paper, which is a call option, and sell the contract itself. That's how you flip paper as it relates to stock options. I'll make another video explaining the put part, but it's pretty much the same thing. You basically make money on scenarios number two if you bought a put. But let me know if this made some sense to y'all. Put some comments in the chat thing below. Go to the website, lsienterprises.com, if you want to expand your knowledge on this. in a one-on-one. I do classes. Like I said, I'm gonna increase the size of the classes and start doing them maybe once a quarter with more people. Class is probably gonna last like a month or two, maybe 1 or 2 days a week. Can't lose your money on that because the information I'm gonna give you is plenty enough information to make profit. You can't lose. If you want to learn on your own, I got when my second book gonna come out. Y'all can check that out. Anyway, I'm taking too much time. Um, like no content creators say, I'm not a content creator. I'm an investor. Tap in, look at the link below, check that out, and I'll leave y'all with this. Go out there and make some money, man. Make educated decision. Make It's all about wisdom, man. Not information, knowledge is okay. It's information, knowledge, and then wisdom. Information is anything, any kind of data, and all data ain't no good. Knowledge is about a particular subject, something you can grow off of. But that knowledge is not power. Knowledge is potential power. It's only power if you got the wisdom to know how to use it. So knowledge is potential power. Wisdom is the power because you know how to apply that knowledge. Either way, y'all take it easy. Get that money. I'll let you boy. Peace.